Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. As is usual, at this time of year, I will stop looking at my daily charts and instead concentrate on the longer term view, using my monthly, even yearly charts to commentate on a market. If you would like to discuss any of these, I'll only too happy to hear from you. So let me now introduce today's longer term chart. Today I'll be looking longer term at euro against the dollar. Back at the beginning of 2021, I pointed out how the market's bullishness was halted with a pair of indecisive spinning tops, right at the top of the recent market. Now I pondered on why the market chose the 123 to 124 area, and also that particular January to peak. It was not due to a single reason, but a coalition of reasons. For starters, the 123.76 level was the 38.2% Fibonacci line of the big 1985 to 2018 move. And it was also close back then to the neckline of the complex head and shoulders top pattern formed over the 2003 to 2018 move, and that's currently at 125.45. Additionally, whilst we had higher highs back in early 2018 and lower lows back in 2012 and 2010, the closes and indeed some of the lows were in that same 123.76 area. In hindsight, it's fairly obvious that the market also did not like closing over the 21st century Fibonacci level at 2130, only managing a single monthly close on two separate occasions. These small twin peaks led to a double top pattern. I also pointed out a few things going forward. Firstly, this move down was the first move below all the moving averages since April 2020, and it led to the development of two new patterns originating back at the end of 2016. The first and simpler idea was the end of 2018 to April 2022 sideways triangle, which I've highlighted in dark blue on my monthly chart. Though not a complete pattern, it's still a verified sideways triangle, made up from the February 2018 to date downtrend, currently at 21.53, and the January 2017 to date broken uptrend, currently at 109.82. I've kept the uptrend alive despite it being properly broken, as I suspected a year ago that it may play a role in the near future, and it has done so in 2023 and now in 2024, acting as a resistance alongside the recent 50% Fibonacci line at 110.45. The second and the more complex idea is the early 2017 to April 2022 cat's ears pattern. This is effectively a double top formed inside a declining market. The sideways triangle had a primary target at 100.25, which was achieved in July last year. It has a much harder to reach target X1 in the 86.05 zone. Now this is not far from target X2 in the 87.15 zone, the target for the cat's ears pattern. However, the market suspended bearish activity as prices late in September 2022 formed a V bottom at 95.34. Looking back, I did find some congestion starting at the 9600 level, stretching from the highs back at the start of 2001 and mid-2000, all the way down to the 8400 zone. However, these did not look that strong and not nearly enough to cause such a V bottom. So I was a little perplexed, and it's another reason why I kept the broken uptrend still in good order, as I suspected back in January 2023 that we may see the beginnings of overhead resistance appear from this broken uptrend and the 50% Fibonacci line at 110.45. Now for guidance, the uptrend crosses the 50% Fibonacci line in August 2024. Thus, like last year and despite the higher markets in 2023, targets X1 and X2 can still be seen as live below the market. Two final features I'd like to discuss now, and ones to be aware of. Firstly, the moving averages. During 2022, we've seen dead crosses amongst all these declining moving averages. The 1 year moving average currently at 108.24, down through the 3 year moving average currently 110.14, the 2 year moving average currently 106.61, down through the 5 year moving average currently 111.49, and a 2 year moving average down through the 3 year moving average. On top of this, we've seen the 1-year moving average form a dead cross in 2023 down through the 5-year moving average. Please note these are all lagging indicators, though so many in a relatively short period of time has no doubt had an effect. The second feature is one I mentioned in last year's annual commentary, and it's become a lot more clearer this year. It is the V bottom formed over 2022. This V bottom has formed in 2023 an extension, or a shelf if you like. This has already come about, but it's worth noting that extensions sometimes turn into bull flags or pennant patterns. These turn into turning into this bull flag or pennant is not really evident as yet, but if it were, then the potential could counter the targets previously listed, with a possible move up for such a pattern to the 120 even area. It would be, as I said last year, and I quote, an extension or shelf would tie in with the possibility that the broken late 2016 to date uptrend may be the instigator for such a pattern, end of quote. Now there is one new feature, a new one for 2023, now going into 24, that could scupper the potential bullishness and support the idea of moves down to target X1 and X2. And that is the newly drawn 2018 to date bearish Andrews pitchfork. Let me draw it for you. This is highlighted in bright red on my monthly chart. The market has from late 2022 through to today moved up from the middle time below, currently at 100.25, up to test the upper time above, currently 110.51. This is where the 50% Fibonacci line, the declining 3-year moving average and the 5-year moving average all currently reside as resistances. Thank you for watching and listening. This annual broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.